We have to conclude our explanation considering again the prospect, the balance sheet we have on the left part of the screen. First of all, we have to change the date at the top of the prospect. We are not at the beginning of the year, but at the 31st of December. And all the transactions we have considered in the profit and loss account have influences that require adjustment in the balance sheet. So we can consider each item in the prospect, and we must control if the value reported, written down in the balance sheet is correct. Premises, equipment, machinery, motor vehicle are still in possession of the company. So we left these items rest with their values. We must skip and consider the current assets. Stock. We have already known, working with the profit and loss account, that we have closing stock. That means that we have controlled the warehouse and found that we have goods unsold for £3,200. Debtors. Have we sold goods that haven't yet been paid by the customers? Yes. The amount of this is 2,400. Bank. We have certainly received from the bank the statement account where we can see what is the balance of the same account, and that is £900. Petty cash. What's the amount of petty cash? The cashier has controlled the cash and has set us to report and to write down here £800. Then liabilities. Liabilities are money due to anybody. Creditors are suppliers, people from whom we have bought goods or other services or things. Do we have to pay something to them? Yes, we have. And the amount of this is £12,400. Now, we can see that the capital employed as at the end of the year is £97,900. We must take into consideration mortgage. The mortgage was lent for £80,000, but we have paid back to the bank £10,000. So the amount due to the bank is now £70,000, and we need to finance the capital employed less mortgage for £27,900. So we must look at the part regarding the shareholders. We know that after having bought and sold the goods, we have had a loss, and the loss that we have to report here, because the loss has to be carried by the shareholder, is a negative amount of £6,600. So we can see that the need of finance is 27,900, and the shareholders finance the company for a lower amount of money. The difference must be covered by them, and the difference is 4,500 that is uh, the money they have to invest in addition as a contributed capital. So 35,000 and 500,000 will be good to let the balance stay in balance, or to make it balanced. We can see here the need of finance and the part invested by the shareholders are equal.